Hello, welcome back. This is Seewing Yi, and today I'm going to go over this week housing market tracker. Today is July the 5th, 2023. So let's dive in. Let me share with you the big picture of what's going on. And I'm going to go over the four aspects of the high level of what's going on that you've been hearing. All right, housing market tracker. Inventory is negative year over year. The slow zombie rise in inventory finally broke under 2020 levels. All right, let's dive in. By the way, this article has been written by this expert, housing wire expert that I really like. His name is Logan Montashami. All right, so he's pretty popular. He get invited to speak quite a bit in the major news outlets about weekly housing data. He's truly a housing nerd, and I respect his very credible information. All right, so today's housing inventory is finally broke under 2022 level. What does that mean? That means that the active listings so far, June 2023, grew by 30,940. Actually, no, this year, last year was 2022, active listings grew 30,940. That was last year. This year, it grew only by 5,840. With mortgage rates rose last week after better than anticipated jobless claims data. But even with the higher rates, we also have a third week of positive purchase application data. This means even with the higher rate, even with the low home affordability in the past few years, we still, the demand was still pretty pent up, and more people are motivated and more qualified to get mortgages than they are undergoing job loan applications. So this is just to go show you the buyers out there, they're still out there, they're still more motivated, they still want to buy a house in light of the challenging housing environment. So again, the quick rundown is active inventory grew by a disappointing 5,800 weekly. Mortgage rates went back slightly above 7%. Mortgage news daily shows a mortgage rate, people with good credit, around 7.03%. So this elevated mortgage rate is still very challenging. The purchase application data show a 3% growth week to week. So weekly housing inventory, as you can see here, weekly inventory changes this past June 23rd to 30th rose from 459,907 to 465,755. And inventory peak for 2023 so far 472. So with that said, even though the housing inventory were higher this year compared to last year, as you can see here, we are still at around 50% less supply of inventory. We have right now, as you can see, 472, a little bit less than half a million, as opposed to the peak, as opposed to the pre-pandemic, which is 2019. Right here, at 2019, we had close to 1 million housing supply inventory. So housing inventory has peaked a little bit, but way below pre-pandemic levels. So as a result, we are still having very severe, one of the top three record low in supply inventory, and the demand continue to be, and the demand for homes by the buyers, demand to be very elevated in spite of the elevated mortgage rate to be around 70%, give or take. Okay. So here it is. Here's the very important chart. This chart are very important when one with very low inventory or 1 month supply inventory and 3% mortgage rate. So we have I've seen a lot of causing bidding wars and skyrocketing of home prices. And then the inventory crept up then in 2022, early part of last year. inventory was very low and still lots of transactions going on. First half of last year, 2022, then the skyrocketing of mortgage rate from 3% on or about from 4, 5, 6, 7%. And then as we entered past the summer of last year and the fall, the mortgage rate skyrocketed from 3% to 7.3% around October of last year, creating massive amount of demand disruption and decreases and downfall. And as a result, now we are recovering as we begin in January. We have very low inventory, but the demand has exploded, and we're seeing double-digit home appreciation so far, nationally speaking. But again, we're undersupplied into the inventory because of the lock-in effect, which hearing from not only myself and a number of other people have been talking about it this past year, and people are holding on to their historically low mortgage rate, and they're not going to move up from a 3% to a 7%. So they are staying put, causing all-time record low inventory. That's why we're seeing upward pressure on both prices in the past 6 months. All right, and let's see what else. And this is another breakdown of inventory by the Autos Research. And up here also, Autos Research supply these very up-to-date data on a weekly basis on supply and demand curve. So they're a very credible source. So here's another indication. Year to date, this black line is 2023. We have seen supply of the inventory a little bit less than 500,000. And the green arrow was for last year, 2022. Last year, we have more inventory on the latter part of the year, second half of 2022. And then 2021, we have a lot less inventory. As you can see right here, it's going below 400,000. So we are right here. So we don't know where this trend line is going to occur for the remaining second half of 2023. If the mortgage rate continue to be anywhere from 6 to 7%, expect the supply of inventory continuing to be limited, which is around, according to Betstamp, the monthly supply of inventory right now is around 2.3%, and it could go lower if the mortgage rate stay the way it is for the foreseeable future. All right, the other big story of the housing inventory is that the new listing data has been trending negative year. So we have seen new listings homes continue to go down throughout last year and year to date this year as well. So this is a trend which is not good. It may continue to decrease the monthly supply of inventory. A traditional seller is also a traditional buyer, right? This means, and are certain homeowners who refuse to buy the next home because the mortgage rates are above 6%. Because if they were to sell their home, they don't, 60% of the mortgage holders right now, they have mortgage rate below 4%. And around 30% of mortgage holders have mortgage rates below historic 3%. So they have lock-in effect. They're not going to move up to buy a home. They're not going to move up from a traditional seller to a traditional buyer if their rates are 3%, and they have to deal with the 7% move up buyer rate. So that does not make any economic sense whatsoever. All right. So again, getting back to new listings, as you can see, the blue and green arrow above here are 2023 and 2022. Year to date in 22, in 2021, the new listings has been around 70,000 to 90,000 year to date, June, the last 2 years. However, this June 2023, new listings is only around 63,000. I'm talking 20 to 30,000 less new listings today versus the past 2 years in 2022 to 2021. If these trends continue, if these black trends continue with new listings, could be level off or even decreasing because second half of each year is during the fall is a seasonality. You will not see as many transactions like we saw supposedly in a strong springtime buying season. So you can make the argument that springtime buying season, historically speaking, is usually a very robust. So over many years, the spring buying season has always have much better numbers, much better transactions. So this year, 2023, there are no spring buying season. This is an anomaly. This is a very rare occurrence. It ever happened before. So again, I call this another record-breaking situation where the spring supposedly robust buying in southern season did not occur this year. Very interesting phenomenon to say the least. So for the past 4 straight weeks of mild declines, and we're about to head into a seasonal decline period of new listings. All right. And almost concluding this, the 10-year yield and mortgage rate, as you know, the 10-year Treasury bond and Treasury yield have a direct relationship with the mortgage rates going up or down. The mere fact that the Federal Reserve and Jerome Powell raising the interest rate on a consistent, systematic basis recently does not correlate to increases of mortgage rates or decreases. Mainly, the 10-year yield is the triggering point that can directly affect the mortgage rates. So one of the data that is this, you have to look at the jobless claims data is one of the correlation that may cause the 10-year yield to go up and down. And also that may cause the Federal Reserve to pivot or to continue to raise to raise the interest rate hikes. So last week, let me give you an example. Last week, there's a big move in 10-year Treasury yield because of the jobless claim came in better than anticipated. The jobless claims came in better than anticipated this past week. And as a result, the bond traders were caught off guard selling the bonds on the news and sending mortgage rates slightly above 7%. Again, the jobless claims came in better than anticipated. All right. And as you can see, the big spike was really about jobless claims getting better. The jobless claims getting better than the Treasury yield or decreases and increases. Therefore, the mortgage rate will stay elevated. So really, the Treasury rate is usually around 2 percentage points below the actual mortgage rate. Let me prove my point here. If the economy stays firm, the 10-year range should be between 3.21 and 4.25, according to Logan Nagadashi. Okay, 3.21 and 4.25, equating to mortgage rates between 5.75 and 7.25. Think about it. This past year, the mortgage rate was between 6 to 7%. Okay. So this range, 5.75 and 7.25, in my opinion, could drag on for the rest of this year. You can expect this kind of mortgage rates for the rest of this year, up and down based on these ranges, these two ranges, low on the low end, on the high end, 5.75 versus 7.25. We are at 7% this week. We are at the higher upper echelon end of this ranges, these two range, the low and the high. Does that make sense? And the rest of this year, okay, some experts predict that the mortgage rate by the end of this year, 2023, is going to be like, let's say the low 6%, maybe even 6% within the range. And some people are predicting, some experts are predicting the first 2 quarters of 2024, we may go below 6%. How much below? Again, the expectation or below, if it is below 6%, it should not go below 7.75%. That is the projection. Okay. No one have a crystal ball. So Logan, the author of this particular article, believe that his range are pretty much very reasonable. Okay. As long as the jobless claims trends are below 323,000 on a 4 week moving average, the labor market stays firm. Jobless claims have stayed below this range all year, and job openings are still at 10 million. So this means the job market is very robust. There are many more jobs than there are people willing to fill those jobs. This market, this housing market is very strange. It's an abnormal market. Okay. It's very conflicting. It's very confusing for people out there. And you would think if there's a recession, if there's a pending recession, then how come the the job claims the job report of the labor market are so robust? Because of recession on people supposed to lose jobs and unemployment rates may skyrocket. That's not necessarily the case. Even if we achieve a minor recession, I could reasonably conclude the labor market will continue to be strong. People could have worked hard, people could continue to have their jobs, and they may not even aware that the recession is going on because people are focused on their unique personal situation. They go to work and provide put food on the table. They just go about their ways. They don't care about the technical definition of recession. The technical definition is 2 consecutive quarters of some technical stuff that is just that baked into a lot of people. But the word recession is very scary. It's just the R word put people in a very uncomfortable level situation. So a lot of people are paralyzed by fear because of this impending recession, inflation situations, and foreclosure situation, which is happening during this economic cycle. It's just a lot of negativity out there, and people are just being bombarded with all these negative headlines, and they're putting their head under the sand or head under the pillow. They don't want to face the reality. They just want to go about their business and just or paralyzed with fear or about buying homes, whatever. So anyway, the 10-year, okay, let's get back to this. The 10-year Treasury is going to be, the rates will be for the foreseeable short-term future is anywhere from 3.37%. Oh, by the way, the technical definition of recession is 2 consecutive quarters of, wow, forget that word. I'll get back to it. The 10-year Treasury is the range is between 3.37% or 2 consecutive quarters of negative GDP, gross national product, gross domestic product, 2 consecutive quarter of negative GDP. That's the technical definition of recession. If there's a recession, it will be a mild recession this time. If you look at the history, never at the back end of the recession, the housing market recovers very quickly. Okay, except one anomaly, which is the 2008 housing market crash and recession. That's the only anomaly. Other than that, like the back end or the recovery or the post mild recession, the housing market rebound very healthy, very robust. Okay, so it's not the end of the world. It's not gloom and gloom out there. Yep, as long as the labor market remain stabilized, people still have jobs, and the recession should not impact people's daily life that much. My opinion. Anyway, getting back to the 10-year Treasury, 3.37 to 3.42. Again, the Treasury rate is usually around 2 percentage basis points below the mortgage rate. For example, if 10-year Treasury is 3.37, the mortgage rate is around 5.37, something like that, on the low end or on the best case scenario, if the treasury rate any given time is 0.42, you plus 2, which is 5.42. So this is the range of mortgage rate that are correlated to the, the 10-year treasury. Okay, so the counter to 10-year yield range would be if the economy here or worldwide starts to accelerate higher. If the economy, if the US economy or the world economy start to accelerate higher, that would be a valid premise to get the 10-year yield above 4.25. So considering our economy this year, the 10-year yield on the mortgage rates look about right to me, right? And on this range that I just shared. So between 5.75 mortgage rate and 7.25 mortgage rate, we can expect to see this most likely on this range toward the end of, to the end of this year, and pretty much maybe perhaps to the entire 2024. You will see at this range. Okay, so my takeaway is that we are going through some rebalancing of the housing market, and there's no housing crash. Okay, all those boom and bloom, all those crash growth out there, all those crash porn that's been touting a crash. And sorry, guys, it did not happen. So I think we need to pivot. We need to talk about something else. And some of these crash bros, they can't talk about crash videos anymore because the crash situation did not occur. So some of the YouTubers, the doom and gloom ones, the crash bros, they are pivoting into, oh, Airbnb crash. That is not happening either. I did 2 videos on the new trend, the new YouTube trend, the new media negative headline trend of Airbnb crash. That's really over exaggerated. Watch my 2 videos and now we'll give you some deep dive as why I do not think that the Airbnb can have any kind of crash whatsoever. It's all about the people want to get famous. Some crash bros YouTube want to get famous. He wants to promote himself, self-promotion, and he's going to all this news media to say that Airbnb are crashing and he has some data to support it. And anyway, we have to take that with a grain of salt. So watch my 2 other videos about Airbnb crash and let me hear what you think. So my recap is that we are going through some rebalancing of the housing market. We still have historical lows on inventory. The mortgage rate still stays elevated. You see some imbalance that as a home of continue to have elevated home affordability issues. Many people can't afford to get a home because of skyrocketing mortgage rates and so higher prices. And also there's not enough homes out there. There's no good homes to buy because sellers are sitting tight. They are keeping the mortgages. They are locked in. They are a mortgage debtors prison. All right. That's all I have to say. Thank you for watching. And if you see value from this video, please smash the like button and subscribe to my YouTube channel. And also subscribe. Put your email on my website below so you can become a free member of our real estate investment club. And so you can, by putting your email on there, you will receive free weekly news, real estate news on real estate investing. We have a community of several thousand members within our community, our investment club. And anywhere in the country, could become a member. And essentially we help people, we help mom and pop real estate investors, whether you are newbie or an experienced investor, to buy out of state remote turnkey cash flow properties. The most robust, fastest growing markets will surround yourself with highly credible professional property management. They do everything for you and the one-stop shop. They do everything for you to maintain the long-term buy and hold investment strategy so you can achieve generational wealth. All right. That's it. Thank you so much for watching. This is Seewing, and I will see you on the next video shortly. Bye-bye.